If you are trying to figure out when mortgage rates might finally go down in 2026, make sure you watch until the end, because the final part explains what really moves rates and what most people misunderstand. For millions of Americans, mortgage rates are the one number that can completely change whether buying a home feels possible or impossible. In 2026, this question matters even more because buyers, homeowners, and real estate investors are all watching the market for the same reason. Lower rates could mean lower monthly payments. But the answer is not as simple as rates will fall or rates will stay high. The truth is that mortgage rates move for several reasons at once, and if you only focus on one headline, you may miss the bigger picture. So today, we are going to break down what is actually driving mortgage rates in 2026 and when relief might realistically arrive. First, you need to understand that mortgage rates are influenced by inflation, the Federal Reserve, Treasury yields, and overall economic confidence. That means even if the Fed cuts short-term rates, mortgage rates do not always fall immediately. This surprises a lot of people because they assume the Fed and mortgages move together perfectly, but they do not. Mortgage lenders care about long-term borrowing costs, especially the 10-year Treasury yield, which often has a bigger impact on mortgage pricing than the Fed funds rate itself. So if inflation stays sticky, mortgage rates can remain higher than buyers want, even in a year when the economy looks like it should be improving. On the other hand, if inflation cools and bond markets become more confident, mortgage rates can begin to drift lower. That is why every new inflation report and labor market update gets so much attention. It is not just financial news for experts. It can change how affordable a house is for ordinary families. Now let's talk about timing, because that is the question everyone really wants answered. In 2026, the most likely path is not a dramatic crash in mortgage rates, but a gradual decline if economic conditions keep improving. That means buyers should not expect a return to the ultra-low rates of the past, but they may see better opportunities than they had during the highest rate periods. In practical terms, even a small drop can matter a lot. For example, on a typical home loan, a lower rate can save hundreds of dollars per month and tens of thousands over the life of the mortgage. That is why many buyers are waiting, refinancing, or trying to time the market. But trying to perfectly time mortgage rates is risky because the market can change faster than most people expect. 1 month of better data can push rates down, and one strong inflation report can send them right back up. So instead of trying to predict the exact bottom, smart buyers focus on affordability and readiness. That means checking credit, saving for a down payment, reducing debt, and knowing your target monthly payment before you start shopping. It also means getting pre-approved so you can act quickly if rates move in your favor. Another important factor in 2026 is housing supply. If more homes come onto the market, buyers may get more negotiating power even before rates fall sharply. That can make the overall housing picture feel better, even if mortgage rates are still not ideal. In other words, rate relief is only part of the story. Price, inventory, and income all matter too. A slightly higher rate can still work if the home price is reasonable, but a lower rate may not help much if prices surge again. That is why the best strategy is to watch the full picture instead of obsessing over one number. So when will mortgage rates go down in 2026? The most realistic answer is that they may ease gradually if inflation continues to slow and bond yields trend lower, but the decline is likely to be uneven. There may be some good weeks and some frustrating weeks, And that is exactly why patience matters. If you are buying a home in 2026, do not wait for a perfect headline that may never come. Instead, stay prepared, track the trends, and be ready to move when your personal finances and the market line up. Because when mortgage rates finally do improve, the people who are ready will benefit first. And if you watched all the way to the end, you now understand the real answer. Mortgage rates do not fall because people hope they will. They fall when inflation, bonds, and the economy finally line up in the same direction.